Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to go over one of my favorite topics on how to maximize your profits by trading debit vertical spreads. Now, when I say maximizing profits, what I actually mean is minimizing your risk, because that's actually the only way to maximize your profits. So I want to talk about debit vertical spreads and show you why this is a strategy that we use heavily in our trading, because it's one of the most efficient ways to take a directional view on the markets with as small amount of risk as possible. And when you minimize your risk and you minimize your capital outlay, that's when you're able to maximize your profits, when you are correct on your outlook in the markets. So today what I'll do is I'll break down the strategy itself. I want to go through as many examples as possible and then go through some best practices for this particular strategy. Now, before I get started, I just want to say to everyone, this unfortunately is going to be the last webinar that I'll be doing in the month of November, because I have some travel coming up, and when I get back it'll be Thanksgiving, so then I won't be able to see everyone until after the holidays. So I hope everyone has a great holiday, and I will see you guys back here in December. However, I am coming to you live from Vegas. So for those of you that are out here for the money show, the Traders Expo here in Vegas, I hope to see some of you here at the show either later today or tomorrow. I will be at the booths all day long. So come and say hi if you are here at the Traders Expo in Vegas. So let's go ahead and get started. For those of you that are brand new to Options Play, welcome. You can sign up for a free 30-day trial to the tool that I'll be showing you guys here today. I just sent a link to everyone here in the chat window. If you can bring your chat window up at the bottom of your screen, please type yes. If you can hear me, please type yes into the chat window, just so I can make sure everyone is here in the chat window is working great. Thank you so much, everyone. So with your free 30-day trial, you'll get access to the tools that I'll show you here today, as well as a free options trading ideas that we send out every single day, which actually ties to this webinar that I'm doing, because the trade ideas that we send out are all debit spreads for the most part. So you're able to not only learn, but also apply some of the things that you learn here using the trade ideas that we send out every single morning. So if you're brand new, please sign up for a free trial, and membership is just $75 or a month, or $500 a year after that. So let's go ahead and get started. I'm going to start off by doing things fairly simple. I'm going to keep things really simple by talking about what are debit spreads. And in order to understand debit spreads, I'm going to first explain a call and a put. Now, most of you are probably familiar with a call or a put, but I want to make sure that you understand the potential risks and rewards of a call option and a put option, and why you might want to consider graduating to trading a debit spread, because a debit spread is actually very similar to buying a call or a put. You get many of the benefits of buying a call or a put, but you can actually reduce your risk and increase your profits with a debit spread over a call or a put. So that's why I want to show you in that particular fashion. And then we'll talk a little bit about when should you use debit spreads. And then what I'm actually going to do is I'm going to switch it up a little. I'm going to jump into Options Play right then and there. I want to show you some examples of debit spreads. And then what we'll do is we'll come back and we'll talk through the management of the strategy and how to trade the optimal selections for expiration dates and strike prices using Options Play. So those are the things I want to go over here today. Now, before I get started, how many of you here currently buy calls or puts? If you buy calls or puts, please type 1 into the chat window. If you have never bought a call or a put before, please type 2 into the chat window, just so I can get a sense for the users here. Okay, so I see a lot of 1s. I see a single 2 so far. So for those of you that are, if you have traded calls and puts, the first part of this should be fairly easy to understand. If you're brand new, hopefully this inspires you to consider taking a look at these types of strategies the next time you have a bullish or bearish view on the markets. So great. So when we talk about debit vertical spreads, there are two types of debit vertical spreads. One is a bullish spread, one is a bearish spread. And they're relatively easy to remember because they have the same as calls and puts. So a bull call spread is bullish, a bear put spread is bearish. And those are the two strategies we're going to break down here today. But in order to understand it, we're going to split this up between bullish and bearish first, and then we're going to go over each one separately. So the first one I want to go over is buying a call option, because it's important to understand the risk and the payoff of a call option in order to better understand why you should trade a debit spread. Because debit spreads can be confusing, they can be complex. So in order to understand, I want to break it down. So in the first example, what I want to talk about is, let's say you have a stock currently trading at $100, and you believe that this stock is going to rally going forward for whatever reason, whether it's fundamental, technical, you believe that XYZ stock is going to rally. So what can you do? A call option is one strategy that you can take when you have a bullish view on an underlying stock or ETF. And a call option looks something like this. So if a stock is currently trading at $100, you might buy a 100 strike call option, an at-the-money call option, and let's say this call option currently trades for $4. So you have to pay $4 to buy this $100 call. And what this provides you with is an interesting metric in the sense that you have a call option that looks something like this. As the stock continues to go higher and higher, you can make more and more money from your call option, because a call option has what we call unlimited max reward, meaning as long as the stock keeps moving higher and higher, you can make more and more money. But on the same token, if you're wrong and the stock declines instead, your max risk is capped at the amount that you pay for that call option at just $4. So you're controlling a $100 stock with just $4. And if you're wrong on the direction of the stock, you're only risking $4. If you're correct on the direction of the stock, you can make unlimited amounts of money. Doesn't that sound pretty good? I think for most people, this is really what makes options. This is why people gravitate towards option, because they don't want to put up $100 a share to trade a $100 stock. And then if the stock declines $10, they don't want to lose $10. If the stock declines $10 here, you only lose $4, yet you still are able to participate if you are correct. That sounds like a pretty good trade-off. However, the downside to this strategy is the fact that because you paid $4 for that call option, your break even on that strategy is actually 104. So not only do you have to call the direction of the trade correctly, you also have to call the magnitude of the trade. So the stock has to actually reach at least 104 just to break even. What that means is that if the stock makes it to 103 or 102, that you actually lose money on this particular trade. Even if it reaches 104, you're just at break even. So what you really need is a 5, 6, 7% gain in the underlying stock before the strategy makes you money in the long run. And that's not always an easy call to make, right? Because it's one thing to say, I think the stock's going to go higher. It's a whole nother thing to say, I think the stock is going to go 5% or 6% or 7% higher. So that's the challenge that you have with trading a call option, is you get this really nice risk to reward payoff where if you're right, you can make unlimited amounts of money. If you're wrong, you have very limited amounts of risk, but you have to call the direction and magnitude correct. So if that makes sense, everyone, please type 3 into the chat window. I just want to make sure everyone understands the concept of the trade-off that you have when you're buying a call option. You have this really nice asymmetrical payoff that works in your favor. And when it goes against you, you have limited risk, but it requires you to have a relatively large move in the underlying stock just to break even. So you really need a big move before you can even make a profit. And that's really where a debit spread comes into play. What we're doing here with the debit spread is we have the same stock XYZ. I believe that this stock is going to rally, going higher in the future. So what I want to do is I want to take advantage of that bullish move with the least amount of capital, because I don't want to have such a large move in order to make a profit. So that's why I want to use a debit spread. So to trade a debit spread, you start with the same call option that you purchased before. Same thing, the buying a $100 call option for $4. Now, if you remember in that call option before, what I'm paying for is unlimited upside. So when I have a limited downside, but then I have unlimited upside. So the question you have to ask yourself is, I'm bullish on stock XYZ. It's currently trading at $100, but do you actually believe the stock will hit 200 or 300 in the next month or two? Chances are you don't. So why are you paying for all that upside? And chances are you've probably never thought about the fact that you are paying for all that upside, when in reality, you don't believe it's actually going to go that far. So what you can do with options, and this is the beauty of options, is you can sell away some of that upside. You can basically sell off that upside by selling, let's say, a 110 call, and let's say collecting a $1 credit for it. So what you're doing here is let's see, I'm going to erase this real quick. What you're doing here is you are still buying the same upside, but you're buying it up to a certain point and then selling the rest off by selling a call. And when you do that, you receive some credit for it. So now instead of paying $4 for the trade, you're now only paying a net debit of $3. So what that means is that, number one, you've reduced the amount of capital you need to place that trade, right? So you're still placing a bullish trade, but instead of paying $4 for it, you're now only paying $3 for it. That might not seem like a lot, but that's a reduction in risk by 25%. Imagine being able to reduce every single trade you make by 25% in terms of risk. What would that do for you in the long run? And this is really one of the things that you're able to get when you're trading options that you cannot do when you're trading stocks, is you can trade off that risk by a substantial amount by trading options instead of the stock. Now, the difference here is that now, instead of having unlimited reward, you've capped your reward at $7. Now, the reason it's $7 is because the distance between these two strikes, the 100 strike call and the 110 call, is $10. And I'm paying $3 for that spread. So I'm paying $3 for a $10 wide spread. So the remaining amount of that spread is my total max reward. So whenever you're trading these debit and these vertical spreads, you're always playing the size between the two strikes. So if the distance between those two strikes are $10, whatever your max risk is, the remaining is your max reward. So what this does is that now it brings your break-even price down to a 103, because you're only paying $3 for this instead of $7. Instead of $4. So now, before we had said that the stock needed to reach 104 in order to break even. Now it only needs to reach 103 in order to break even. So what you're basically saying is that now, if the stock does make a 4% run, I'm actually able to make money on this trade, not just break even. If it reaches 103, I'll break even. And if it reaches 110, I'll actually make a higher return. The only time that a debit spread underperforms is if you get this astronomical move up to, let's say, 115. Now you've capped your gains and you're not able to take advantage of that. But if you do this correctly and you sell a strike price that's far enough away, chances of that happening is relatively low. And what you're doing is you're trading off what's happening very frequently by reducing your risk most of the time, in exchange for a few times when the stock really takes off and you're not going to be as profitable as you would if you just bought a call option. But in the long run, this is going to work in your favor. Now, if this makes sense as to why you want to sell off that higher premium that higher strike price in order to bring in some premium, reduce your risk and reduce your capital outlay, please type 4 into the chat window. Perfect. I see a lot of 4s. Great. So this is why you want to consider using a debit spread. And this is why I call it one of the most efficient ways to deploy your capital when you have a directional view on the market. Now, Normally I would go through a bearish example, but from my purpose, from my perspective, it's identical. We're just flipping it on a dime from bullish to bearish. So now instead of expecting the stock to move higher, we're expecting to move lower. So now we're buying a put option. I'm not going to go through all of this again because I think most of you understand flipping from bullish to bearish, but the idea is the same. If I bought a $4 put option, I need the stock to move $4 lower in order for me to be profitable. So the stock needs to go down to 96 just to be profitable. What that means is that I need a move to happen below 96 just to be profitable on that put spread. I'm buying that put. So one of the ways that I can reduce my capital outlay and my risk and make myself potentially more profitable is by selling off that put. Because when I'm bearish on stock XYZ, I don't actually believe it's going to go down to zero, at least not in the next month. So chances are what I want to do is I want to sell a lower put, bring in some credit, and let's say that credit is $1 again. What that does again is it reduces my risk. It does cap my risk from unlimited to $7, but chances are I don't believe the stock's going to zero anyway. So even though we call that unlimited profits, it's not truly unlimited in my belief. And what I've done is I've made myself a better break-even price. So the stock does not need to move as far in order for this strategy to be profitable. Now, if that makes sense to you, please type 5 into the chat window. Great. Okay, I see a lot of 5s. Perfect. So that is in essence the strategy itself as to why you want to consider using a debit spread whenever you're thinking about buying a call or a put. So just to recap, what you want to do, the debit spreads is really one of the best ways to take a directional exposure with a defined move. And what I mean by a defined move is, debit spreads are good for when you expect, a fairly large bullish and bearish move, but it's not based on some kind of catalyst like an earnings event or maybe a news event or a product launch where you expect that maybe the stock might make a really big move in a short period of time. This is more so for maybe some technical, for those of you that use technical analysis, maybe you've identified an oversold point, and you believe that the stock is going to start moving higher. Maybe you believe that this is a relative low, and you believe that the stock is going to continue moving higher. So that's why you believe that the stock is going to continue in that particular direction higher. But you have a defined move, meaning you believe that there's going to be a move to maybe a previous resistance level or whatever that is. You have a target price on that move, meaning this is not something that's because of an earnings announcement. You're not expecting a quick move either higher or lower because of some kind of announcement. You're expecting more of a directional move based on technical indicators. That's usually a good time to use these types of debit spreads. So many times you might have a stock that's breaking above a resistance level or breaking down below a support level. Typically on strong momentum stocks, these are suitable. The only scenario where you should not use a debit spread is when you expect a modest or neutral move. And what I mean by that is many times you might have a stock that just trades within a range, right? Where you see that the stock is just trading within a range. And when you see that, where you're only expecting the stock to make a relatively small move, either from one support level to the next resistance level or further down, where the move is not a significant move. Again, in that $100 example, you needed a 4% move just to break even. So you need a 5, 6, 7% move in order for that strategy to be profitable. And sometimes the stock might be trading in a range where it's just 4 to 5% in a range, and you're not getting that big move. Not a suitable strategy. There are better strategies for this. You should sell a credit spread when you reach this type of overbought, and oversold here when you sell a credit spread. But that's a whole different strategy for a whole nother webinar. Debit spreads are for when a stock finally breaks above that resistance level. So you've had this stock that's trading at this resistance level for quite some time. This is a stock that's been trading in that resistance level, and it finally breaks above it. So you're expecting the stock to make a big move to the upside. That is when you want to consider using that debit spread. Now, if that makes sense, everyone, please type 6 into the chat window. Okay, perfect. So with that, what I want to do is I want to jump over to options play, and I want to show you guys some examples of debit spreads. And what I want to do is I'll come back and talk a little bit about how you want to choose the optimal debit spread. So, at this point, what I'll do is I'll open this up for symbols. If anyone has some symbols that you want to take a look at, just type in the symbol and whether you're bullish or bearish on that symbol, and we'll take a look at some debit spreads, and I will show you kind of comparing the call or a put to that debit spread. Casey is asking for IDV. I'm not familiar with this. This looks like this is a ETF. Guess what? These options are not very liquid, and I wouldn't trade these by the message that we saw on this. So Casey, I wouldn't trade options on this particular ETF. Doesn't look like it's very liquid. VJ is asking for QQQ. NASDAQ 100 index ETF, very strong index currently, trading just around that 200 level. So let's say you were bullish on the Qs, and buying a 100 shares of that stock will cost you $20,000. Buying a call option will cost you $463, so about 2% of the underlying. Buying a call spread, $408, just about 2%. So this is a little over 2%. This is about 2%. And what you can see here is that, the Qs, recently broke above this big resistance level at 195. I expect it to maybe consolidate a little before we start to make that move to the upside. But as you can see here, let's say we get a modest move to, let's say, 205 here on the Qs. As you can see here, if you get a modest move up to 205, because you're paying $4.63 on the call, your break-even price on the stock is 204.63. So if the stock goes up to 205, you barely make a profit. On the call spread, because you've reduced your cost basis from 463 to 408, your new break-even price is about 204. So if you get up to 205, as you can see, instead of just barely breaking even, you're looking at about a 22% return. Certainly not, in my opinion, attractive, but this would be the bare minimum to even look at a bullish strategy using options. So this is where you have to ask yourself, do I believe the Qs are going to get up to 205 or higher by December 20? Maybe you think that we're going to have a strong end to this year, and I certainly are. I'm in that camp. So let's say you think the stock's going to move up to, let's say, 210. As you can see here, if the stock moves up to 210, you're looking at a 4.7% return on the stock, an 115% return on the call option, because you're making roughly $530 profit on a $463 investment. That's 115. But as you can see here on the right-hand side, I'm looking at 145% return. I'm making almost the same amount of profit, 537 versus 592, but because I've reduced my risk and my capital outlay from 463 to 408, that amplifies my returns from 115 to 145. So this is really what you get from trading that debit spread. And more importantly, what if I'm wrong? What if we get another sell-off going into the end of this year like we had last year? What if the Qs, what if the Qs end up something like back here in the 180 range? This is exactly what we saw last year going into the Christmas. And if you had bought 100 shares of the stock, you're looking about a $2,000 loss. If you bought a call option, $463 loss, a call spread, 408. So not only did I get the better return here on the vertical spread when I'm right, when I'm wrong, I risk the least amount of money. That's how you maximize your profits in the long run, is you get yourself a higher profit when you're right, you get yourself a lower risk when you're wrong, and if the stock doesn't move, you still risk less money than if you bought a call option. So that's how you can utilize options play to help you quickly find some directional plays. May is looking for a bullish play on Boeing. So May believes that maybe the planes will get fixed sooner than later. So May wants to take a bullish view. So let's take a look. $35,000 to buy 100 shares of that stock, $14.85 to buy a call option, $12.72 to buy a call spread. So I don't know how far you think Boeing can make it. It's been pretty range bound for quite some time, and the upper bound of that range is about 385. So let's say you think it's going to make it back up to that 385 range. And I don't think that that's crazy, as if there's any decent news that comes out on this particular stock, that you get a move up to 385. 7% return on the stock, 102% return on the call option, which is pretty impressive. But as you can see here, by reducing that risk from reducing my capital outlay from basically $1,500 down to $1,250, I'm looking at a bump in return from 102% to 135% return. And let's say Boeing crashes back down to this low, which is around 130 or so. So if it trades to the bottom of that range, a $2,700 loss on the stock, a $14.85 loss on the call, $12.72 loss on the call spread. That's why you have the highest options play score. So this tool is really designed to take exactly what I've taught you and apply it very, very quickly. Stephen is bullish on JD, and interesting here, JD recently broke out above what I would consider a pretty massive resistance level, broke out, came back to test it, and looks like it's starting to move higher. Great setup from a technical perspective. Exactly the type of trade that I would use a debit spread for, right? Because when you get these types of breakouts, sometimes you kind of get a fake breakout, and it just trades right back into that range. So you want to make sure that you protect yourself in that case, right? Because I've seen a lot of these kind of breakouts happen where it goes out there for a couple of days. Next thing you know, it rolls back over, right? And you want to make sure that you protect yourself in that case if it rolls back over. So here, if the stock goes down to, if the stock pulls back to, let's say, 28 bucks instead, and again, this is very possible if that happens. Notice how if I bought the stock, I'm down $528. That's a lot versus $200 risk on the call, which is not a lot compared to the $528. But as you can see, the call spread, I'm only risking $161. So if I'm wrong on this trade, I'm losing significantly less money than the stock or the call. But if I am right, what if who wanted JD? Stephen wanted JD. So, as you can see here, this stock went from 28 to 32, a $4 move relatively quickly. So let's say you get another $4 move to 36 or 37. Let's say you get a move up to 36.5. Here, 10% return on the stock, great return on the stock, 75% return on the call, which actually is, in my opinion, not very attractive. That's why you have a low options play score, because that's telling you that these calls are pretty expensive. Normally, I would expect these returns to be closer to 100, but as you can see, the call spread 117% return. So that's what that $40 savings gets me in the long run. It gets me a significantly higher return if I'm right, and less risk if I'm wrong on this particular trade. Great setup, Stephen. I might actually use this particular trade. CVS, this is one of the trades that we are in. I will say CVS is a little bit overbought here. I'm concerned about getting in long here. And if you're going to go longs here, I would highly recommend you to consider using a debit spread, because I think you have a high chance of this stock pulling back in the short term. I'm still think that this stock can move higher, but severely overbought at the current price. So as you can see here, a debit spread, let's see, maybe they're, so the problem here is that CVS doesn't list a lot of strike prices. So what you have here is, you don't have a lot of choice. Normally I'd probably pick somewhere in between 75 and 80, but that's a pretty big gap, $5 on a $71 stock. So that's why this vertical here doesn't really look particularly attractive to me. Because there just aren't enough strikes to trade. And sometimes this is why I like to trade the weeklies, because as you can see here on the weeklies, you get a lot. You have 50-cent strikes. So maybe let's compare a weekly. $70 call option versus 70 by 76 call spread, 305 to 267. You save about 40 bucks. But as you can see here, if you do get that move to the upside, now I don't know how far this stock can go. I think it's time to take profit on the stock, not get long this stock. But if you're super bullish and you think the stock can go up to 75 or 76, as you can see, this $40 savings equates to about a 30% gain in the underlying stock, and you're risking $40 less. I'll do a few more here. Kevin wants BMY. This is another stock that we've recently taken profit on. Similar to CVS, notice that little pullback that you got. I think that's what you're going to see in CVS before it continues to move higher. Maybe this stock is kind of pulled back and is ready to prime its way higher. This stock has had a hell of a run since $42 to $57. But you think the stock can keep going, Kevin. So take a look at vertical spreads, because 175, that's an expensive option by looking at the options play score. But if you do get a run, even to $61 here, a 5% return on the stock, 100% return on the call, 124% return on the call spread. More importantly, my concern is that you get a pullback here on any bad news in the markets. If even though healthcare is very strong right now, but I think there's some risk here. If you do get that pullback, a $472 loss on the stock, $175 loss on the call, $156 loss on the call spread. Let's see. I got a lot more here. I got a lot of Beyond Meats, and I got a lot of Roku. So let's take a look at a Beyond Meat. Now, this is an interesting one. And I say it's interesting because this stock was a crazy run, and it's just slowly dying a slow death. It's coming back to this initial support level we had around 75 bucks. I think people started to realize that as much as these Beyond Burgers are nice, it's really just heavily processed food. I don't know. Are you bullish or bearish on Beyond Meat? Lewis is bullish on Beyond Meat. Someone else said Beyond Meat as well. Lewis did. It was all Lewis. Lewis is bullish on Beyond Meat. So let's take a look at some bullish plays on Beyond Meat. Interesting. $7,900 to buy 100 shares, $850 to buy a call. So more than 10% of the underlying stock to buy a call option. That's an expensive call. Buying a call spread, 704, just under 10%. Very expensive call spread as well. But let's take a look. You're bullish on this stock, right? So this stock, can easily make a move back up to 108, 120 in that area, which is crazy. But let's say you get a move up to 108. Look at this. A call option is actually better because right now, this stock is pretty crazy. It can make some big moves. So if you do get that big move, as you can see, here is where you can get a big move. So before I talked about chances are of getting a big move, not very high, but this is one of those stocks where you do. So in this particular case, you might actually be better off trading that $75 call option. It only costs you $150 more, but as you can see, you can make substantially more profit. Instead of $1,200, you can make $2,400 profit. So I would certainly pay an extra $100 to try to make an extra $1,200. So as much as I want to talk about the benefits of debit spreads, there are times when you use a tool like options play where you're going to discover, hey, I'm better off buying that call option. And that's the power of options play, because as much as I'm here to tell you about strategies and teach you best practices, you can see for yourself using options play which strategy is best suited for you and your outlook on the underlying stock, because your outlook has a big weighting behind which strategy is best suited for you. A stock like Beyond Meat, I would be comfortable just buying that call option. I would rather pay that extra $150 and try to make an extra $1,200. And this is what the tool provides you with. Wayne wants to look at Disney. This is a stock that I'm not particularly strong on. I think the streaming wars really just hurts everyone. I don't necessarily know there's any clear winners in this particular space. And I think these stocks just kind of grind their way out. I don't really see a big move in Disney myself. Wayne, I don't know if you're bullish or bearish. Again, please, if you're going to give me a symbol, please tell me if you're bullish or bearish on it. But let's just assume you're bearish on Disney. Let's say you think that, there's this huge vacuum here from 126 all the way down to 117. So Wayne said he's bullish on Disney. So let's take a look. Bullish on Disney. Interesting. $13,000 to buy 100 shares of that stock, $625 to buy a call option, $522 to buy a call spread. A significant savings, $100 here. That's almost 15% here that you're saving on that call spread. So as you can see here, if you do get that move up to, let's say, around that 140 mark, that's kind of a big resistance level there. If you get that move up to 140, 60% return on the call, not super attractive, 91% return on the call spread. That would be kind of the bare minimum that I would be looking for. But again, I don't really see this being a huge move to the upside very quickly. If anything, it'll grind its way back up. It's just not a stock that I think has a lot of catalyst to make big moves because of all the streaming wars. But hey, everyone has their own views on the markets. I'm not here to tell you how to trade. I'm just here to help you understand what strategies might be best suited for you. Jim wants to take a look at Activision. This is an interesting stock. I actually like the stock myself. Big base it's formed, but it's really, and I thought this was going to break out and move significantly higher up to that 63 level, but it has done nothing except for just move sideways. So, maybe one day it makes that big move. I don't know when, but I certainly like this stock. I like the sector it's in. I like what they do. I think they're a leader in this particular space. But not sure when that move is going to happen. So this actually might be a case where you're better off buying the stock and waiting it out. But let's say you want to buy that call option because you think maybe Christmas is going to be a catalyst. $5,300 to buy a stock, $425 to buy the call, $361 to buy the call spread. If you do get that big move back up to that $63 vacuum level, 17% return on the stock. That's pretty damn good. 147% return on the call, 177% return on that call spread. Certainly, call spread makes a lot of sense, but like I said, this thing has just been stuck in this range for quite some time, and I don't know how long it'll stay remaining stuck in that range. But if you think it's going to make a quick move, maybe buy that call spread versus otherwise, I think you might be better off buying the stock. So with that, I think I showed you enough examples to show you, number one, how easy it is to take any idea, any stock, whether you're bullish and bearish, and how easy it is to use options play to set up looking at a vertical spread. Now, that's the first step. It's just setting it up, looking at it, and seeing if they're suitable for you. Once you get more comfortable with it and take a look at some of the daily plays that we send out and maybe trade some of those, that's when you're going to get more comfortable where you might want to modify them and change the expiration dates based on different outlooks that you have. Maybe some of you have longer outlooks. But what I want to do now is I want to go back to the slides, and I want to show you why we choose certain expiration dates and strike prices. So whenever we're talking about debit spreads, the optimal debit spread needs a minimum of 5 to 6 weeks because realistically, in order to get that move that you need in order to be profitable, you need time. And if you only buy yourself a 3 to 4 week vertical spread, you're generally not going to see those types of moves. So you generally need a minimum of 5 to 6 weeks. And because you're long an option, you have time decay working against you. And one of the best ways to minimize that time decay is by buying longer dated options. Even if you only intend on owning a trade for just a couple of weeks, you should still buy a longer term option 5 to 6 weeks out, hold it for a week or two and get out. Because during that 1 week of a 6 week option, it's going to decay far slower than the 1 week of a 2 week option. as far as strike prices go, this is really where it's pretty straightforward from our perspective. We always want to buy a slightly in the money call or put, and then we want to sell a call or put that's relatively far away, a 10 delta call or put. So when we talk about a $100 stock and we're selling that 110 call against it, we're picking that 110 call based on probability. We're actually looking at what is the probability of this stock reaching 110 based on the volatility of that stock. And we're picking a strike price that has roughly only about a 10 to 15% chance of reaching that price or higher. So again, we need to help you maximize we want to sell off your upside, but we don't want to sell off too much upside. We only want to sell off the upside that's not really, that's unlikely. That's why we always use a probability-based approach to selecting that upper strike price. If that makes sense to everyone, please type yes into the chat window. Why we want to use a strike price that's relatively far away so that you're not hitting that very often, because if it hits that, that means you've made a pretty big move in the directional move. So when you pick that relatively far out of the money call or put, you're going to receive about 10 to 20% of the premium of the long leg. So what you sell in that 10 to 15 delta call or put will roughly offset about 10 to 20% of the long call or put. When you do this, you're going to see relatively lower probabilities of profits. I get a lot of questions from users saying, why do we trade debit spreads that have a 35% chance, 40% chance of winning? The answer is because I have really good risk to reward. Because for every $100 I risk, I generally can make roughly $200 in reward. So significantly better risk to reward with a lower probability of profit. There are plenty of other strategies that you can trade that have very high probability of profits, but you're risking $300 just to make $100. Those are not the types of risk reward that I love taking every single day. I like taking risks where I risk a small amount, and if I'm right, I make a larger amount of money. That's why I prefer trading debit spreads. Now, I just want to make sure everyone understands this before I move on, why you want to pick these types of expiration dates and strike prices. Okay, great. So lastly, let's talk a little bit about how to manage debit spreads. So whenever we're trading debit spreads, like I said, you want to time your entries with an expected large move. So I think Steven had that JD example that I thought was a prime setup where a stock, traded against a resistance level for months, finally broke out above it, came back to test it as support, and it looks like it's about to start moving higher. Those are the best times to enter one of these types of debit spreads. Now, whenever you're buying a debit spread, you always want to exit the trade prior to expiration, just like a long call or a put. You don't want to hold that to expiration. You want to you always want to exit the trade prior to expiration, either at a gain or a loss. Now, the rule of thumb here is whenever you're buying a debit spread, you have rules as to when you want to cut losses, and you have rules as to when you want to take profits. And one of the reasons that I really also additionally like trading debit spreads is because the rules for managing them are really simple. There are other trades like you can make like credit spreads or iron condors that get really, really complex as to when you have to adjust them, how to determine when it's time to take profit, when it's time to cut losses. And they depend. There's a lot of dependencies as to which rules you want to use. So they get complex. With debit spreads, they're really straightforward. Same thing with calls and puts. When you buy a long call or a long put, the rules for taking profit and cutting losses are really simple. And they are the same regardless of what type of calls you purchase, how long dated they are. It doesn't matter. The rules are the same. So cutting losses at 50% loss, taking profits at least partial profits at 75 to 100% gain. So what that means is that if you buy a debit spread, let's say you buy a 100 by 110 call vertical, let's say you paid $2 for that call vertical. What that means is that if you bought something for $2 and it's now trading at $1, which is a 50% loss, it's time to cut your losses and move on. So you can think about debit spread as just like buying a stock. You know, you pay $2 for that stock. If it goes down to $1 and you lost 50%, it's time to cut your losses and get out. On the same token, if that $2 stock that you bought goes up to $3.50 or $4 and you've made your 75 to 100% gain, it's time to get out of that trade. So you can ask yourself, you know, have I made a 50% loss or reached 75% to 100% gain? If you have, then it's time to either cut losses or take profits on that individual trade. So really simple rules. I just want to make sure everyone understands that before I move on. If you do, please type 1 into the chat window. Okay, perfect. Great. So with that is all the rules and slides that I have regarding debit spreads. I just want to show everyone, again, if you're brand new to debit spreads and you're trying to learn, we send out debit spread trade ideas every single day in our daily play. It's free with your Options Play subscription. It's a directional stock idea that we send out in the mornings with a debit spread trade attached to it. You get an email every single day at 6 a.m. or you can access it just by logging into your optionsplay.com account. And when we send it to you, you get a link that allows you to look at that strategy within Options Play, allows you to compare a strategy. So if you get a link and tomorrow we're looking to go long JD.com like Steven found, I think this is a compelling trade to make. Let's say you get this trade. What you can do is you can use Options Play to actually analyze how the strategy will perform. You can see if you agree with our analysis on JD. You can see if you believe that this stock's going to move up to, let's say, 35 or 36 bucks, and you can see, well, how much money do I make if the stock goes in that direction, and how much do I lose if the stock turns around and goes back down to 28? Doing this type of analysis is extremely important to understanding the strategy before you place that trade so that you know what is the best possible outcome and the worst possible outcome before you get into a trade. The last thing you want to do is get into a trade and then realize it's not working out the way you expect it to. Our P&L simulator truly allows you to understand how the strategy performs, whether the stock goes higher or lower, so that you can see which strategy is actually best suited for you. You don't want to just follow someone else telling you to trade something blindly. And with this, what you can do is you can take a look at our previous trades by going to optionsplay.com/dailyplay, and you can even track the performance of all of our trades at this particular link on your screen. And this will be sent out to everyone as part of the recording. We always send out the recording and the slides about 30 minutes after we finish every single Thursday. So please, if you want to learn more about this, I highly recommend you to take a look at the daily play ideas because they are designed from the ground up to do exactly what I just taught you here today. So with that, I just want to thank everyone for taking the time out here this afternoon. I really appreciate everyone taking the time to participate and provide your ideas and symbols every single week. And I'm really happy to be able to show you guys these types of strategies and the tools so that you can utilize them for your own. And I hope that you consider supporting us by becoming a member. You can do that by clicking on the link that I just sent into the chat window. Included with your subscription is daily trade ideas, weekly options education webinars, cover calls and cash secure put reports for those of you that like to generate income, and our 12-step options trading course. And I just want to remind everyone, this is going to be my last webinar in November because I do have a couple of weeks of travel coming up. And when I get back, it'll be Thanksgiving. And unfortunately, I won't be giving a webinar on Thanksgiving. So the next one, I will actually see all of you guys in December. But again, I am here in Vegas. So for those of you that are here for the Traders Expo in Vegas, I hope to see you guys here. Please come by and say hello at the booths tomorrow or later today, and I hope to see you guys there. So with that, what I'll do is I'll open this up for Q&A, and I want to allow you guys to ask any questions that you might have on any given strategy that I just discussed here today. So let me scroll up because I think there were a few questions while I was talking earlier before. Let's see. No, I can't seem to find them. Here we go. Wayne asks, would you sell out of an S1 range 68%? Wayne, I'm not sure what an S1 range 68% means. If you can clarify, I'm happy to answer that question. Casey is asking, in order to be profitable, is there any relationship between vertical width and the price of short leg? There might be. I haven't thought about that relationship because there is a relationship between the price of the short leg and the width of the vertical on a credit spread. So I would imagine that there is some kind of relationship there for debit spreads as well. But I'll be honest, I haven't thought through that. I'm going to need a few minutes to think through that. Casey, if you want to shoot me an email at info@optionsplay.com, I'm happy to think about that a little further and answer that question. John is saying, I might have missed it. You covered it, but I am wondering, why should I use a debit spread versus a credit spread? So John, I would love to explain that, but I actually did a whole webinar on this just a couple of weeks ago on comparing debit versus credit spreads. And to answer your the short answer to your question is that there's almost never a time where you should be comparing a debit to a credit spread because they are two completely different strategies. It's like comparing buying a call to selling a put. I would never, I would never imagine, well, should I buy a call or should I sell a put? Because the two strategies are so different. That's what a debit versus a credit spread is actually comparing. Because when you're thinking about buying a debit spread, that bull call spread, it's like buying a call option. And when you're selling a credit spread, it's like selling a put. Those two should not be in the same sentence. So that's why I generally am not in a position where I'm comparing buying a call or a debit versus credit spread. You have to first determine, do I want to buy a call or should I sell a put? And once you determine that, then you can determine what's best for you if you want to buy the debit spread or sell the credit spread. Peter, Wayne, Paul, you're very welcome. Louis, same thing. Patrick, thank you so much. Patrick, I hope to continue the TMX webinars soon. That is something that we are talking to TMX currently about continuing. Wayne, Gene, thank you so much. Lewis is asking, does options play use iron condors and butterflies? Now, I will say, me personally, not a big fan of that strategy, but if you want to trade them, absolutely. Click on the modify button. We have a strategy constructor. You can construct butterflies, condors, everything here by the click of a mouse. I don't like to trade these strategies because trading a condor is trading two separate credit spreads. You're basically saying I'm bullish and bearish at the same time, and I don't have any technical indicators that tell me I'm bullish and bearish at the same time. These types of strategies are more volatility-based strategies. I like to trade directional strategies. That's my personal preference. Wayne is saying standard deviation range. Would you sell out of the one standard deviation range? So if you sell out of the one standard deviation range, so first of all, our modify, when you click on modify and you click on the strike prices, we actually show you where the one standard deviation range is on a specific expiration date. You can sell out of the one standard deviation range, but what you'll see is that you're going to get very little premium. So the long leg cost me $2. If I sell a $40 strike, I'm only getting 18 cents for it. You just have to see whether or not you're getting enough premium. The goal here is to provide a significant savings over buying the call option. If you're not getting a significant savings, so here going from 200 to 182, you're not getting much of a savings. So you have to determine how much. A lot of times on most stocks, when you go too far out, you just don't have enough premium. You might get 5 cents for it. It's just not worth selling something for 5 cents. Marty is saying, is there a cheat sheet or a reference sheet for all types of option trades and basic rules for each strategy like you showed today? Marty, we do. Good question. I don't have a cheat sheet, but actually, that maybe is something that we should put out. Thank you for that. Thank you for that thought, Marty. I think that's a good advice. Claude, when we want to check the break even, etc., of a trade we have already on it, would it would be fun to be able to change the actual premium we paid in the strategy constructor or something to eventually be possible. Claude, yes, that is something that we are working on, is being able to import your portfolio from your brokerage firm directly into the portfolio tool. So we use our portfolio tool to track our daily play trades, but we are also going to create a way for you to put in your own trades in here. So that is something we are working on, absolutely. Blair, Majid, Wayne, Claude, thank you so much. I really appreciate it. Let me see if I think I might have a few more questions here. Okay. Harsh is saying, please review PHM. It's pulling back. Yes, this is a trade that we had. We're only down 9% on this trade. So yes, it's pulled back, but it's still well above this support level that I was expecting it to hold on. It's pulling back. But when you're down 9%, it's just not quite there for me to pull the trigger of triggering losses. I will say this other trade here that we do have on the other home builder, Lennar, this might be time to pull the trigger on closing that trade because we are down 57%. But it is time to take profit on CVS. We're up 108%, meeting our thresholds. So we try to use the rules that we show you on these debit spreads to determine when it's time to cut losses. Leonard, I think, is a time to cut losses, but CVS, time to take profits. Tony, are you an advocate of keeping under 4% ratio of premium to price of value options? So not really, but I would say most large cap stocks, you will find that rule to be good enough because, unless you're trading stocks like Beyond Meat, most calls and call verticals will probably be within 5% of the underlying stock price. But if you're trading Roku, if you're trading Beyond Meat, you're going to find that that's going to be a tough one. So it really depends on what you're trading. If you're trading the more volatile stuff, you're not going to be able to find 4%. If you're trading large cap stuff, you should be able to stay within 4%. Do we get the daily play debit spread trades during the trial month? Yes, Giovanni, you do get the debit spread trades during the trial month. Andy's asking, daily play mostly has debit spreads, no credit spreads or cover calls. That is correct. The daily play is meant for directional trades. Credit spreads are not directional trades. Credit spreads are more neutral trades. We do have a separate service on credit spreads. So Andy, if you want to sell credit spreads, we have a whole service just on that. As far as covered calls go, we publish a report every single Monday for you on covered calls. We look at all S&P 100 stocks, and we show you which stocks have the highest yield on a covered call. So we do cover all of those things, just not in the daily play. Tony's asking, in profiting from CVS, and I'm looking to close the short side and let the long side run, but you said it's overbought. Help me understand why not to hold the long call. Well, the long call is the profitable one. So if you hold on to it and you get out of the short call, and the stock drops, you will actually lose more money on that trade than if you held on to the short trade, because the short trade is what's going to make money if the stock pulls back. Again, I don't think of a debit spread as two separate legs. I like to think of it as one strategy. It's just a vehicle to trade a long or short stock. I never split up the two legs. You can get really tactical and really if you really want to get tactical, you can. I just don't think I'm that good at calling the markets to be able to say exactly when something's going to turn on a dime. You need to be spot on perfect in order to break up, multiple legs in order to trade that. Giovanni would love a cheat sheet. So Marty, thank you for that feedback, Giovanni. We will look into creating some cheat sheets for you guys for these types of strategies. In the strategy constructor, I can't locate an iron condor. It's in there, I promise. Modify, sharp move or neutral. You have the call condor, the put condor, or the iron condor. They are all there, I promise. Victor, does your model consider implied volatility with debit spreads? Absolutely. That's how we select that strike. So when we talk about using probability-based approach, we have to use the implied volatility to calculate the probabilities. So when we say on the JD.com, when we're going to sell the $38 call, and the $38 call is the 1 standard deviation move, that's calculated based off the implied volatility of the stock. So the larger the implied volatility, the further away we're going to sell. The lower the implied volatility, the closer the strike we're going to sell. So absolutely, Victor. Ram, thank you so much. David, do you have an options chart? If you're talking about a chart for the price of the option, the answer is no. I will say, if you are really looking for that, I think one of the only platforms that offers that is Thinkorswim. Any comments on long combo? If by long combo you mean a synthetic stock, where is that? Long synthetic stock. I don't particularly have a comment on it per se. I don't know why you would trade a synthetic stock when you can just trade the stock itself, because to sell that put, you're going to have to put up the cash that you need to sell that put, and you're trading 2 contracts, so you have to pay the bid-ask spread on the call and the put. I don't know why you would do that when you could just buy the stock for virtually no transaction cost. So I'm not a big fan of trading these synthetic stocks. Andy, in terms of your question, if you don't mind, send me an email at info@optionsplay.com and I'll point you to the right place. In the strategy constructor, I'm trying to construct an iron condor where the legs are, yeah, so it's right here. You go to neutral and short iron condor. So with that, I just want to thank everyone for taking the time out here this afternoon. I really hope that you guys have found this useful. And please send us your feedback. You know, Tony, you're asking about diagonals. We do actually talk about diagonals. We talk about it during our LEAP webinars. So we talk about how you want to buy a long-term call and then sell short-term calls against it. We call it a poor man's cover call. You know, you can call it a diagonal. They're all the same thing. But it is something that we do talk about. It's not something I trade very often because I don't trade long calls or puts super often. But it is a trade that you absolutely should do. But from my perspective, you know, I don't think of them as 2 separate trades. I think of them as 2 separate trades, not as a single trade. You have to first have a long-term bullish and bearish view by buying that long call or long put, and then you want to sell short-term calls against it to offset the cost of buying that long call or put. So it is something that we do talk about, and I hope that you take a look at our LEAP webinar if you want to learn more. So with that, I want to thank everyone for taking the time out here this afternoon. Again, I hope you guys found this useful. And again, just a reminder, please, we are going to resume this in December. I am unfortunately traveling over the next couple of weeks, and the last week is going to be Thanksgiving. So I will see you guys after the holiday break. I hope you guys have a great holiday and see you guys in December. Have a great evening.